Good morning, good afternoon, good evening, whenever you're watching us. It is Chris Carlin from Vista Financial Group and Master Your Money Now. Just doing a final sound check before we start in approximately 10 minutes time. So if you are watching this live, I'd say make sure you in the meantime, make sure you follow us on social media, give this video a like, and grab yourself a cup of coffee, lunch, whatever it might be, and we'll get started in 10 minutes. If you are watching the replay, just fast forward 10 minutes to when we go live. Again, we're making sure everything's all good. It looks like that it is. We will speak to you very soon on this very exciting topic, from saving to investing, a beginner's guide to starting an investment portfolio. Good morning, good afternoon, good evening, wherever you're watching this. It is Chris Carlin, Senior Financial Advisor and Head of Education at Vista Financial Group and Master Your Money Now. I'm very excited to be joined by Financial Advisor Patrick Chipp. Pat, how you going?
Yeah, good. Thanks for having me on.
That's all right. No, great to have you here as well. If you are watching this live, make sure you give us a like and leave us a comment as well. Whereabouts you're based and what are you looking to get out of this webinar? If you've got any questions for us, please let us know in the chat and we can go from there. And we've also got our social media links in the chat as well. So we've just ticked over 12:30 and I know your time's important. I know most of you are on the lunch break. So let's get straight started into this topic from saving to investing. And I'm pretty excited about this because when we're doing this right now, it's August 2023. Interest rates are very high at the moment. Inflation out of control. A lot of people we're hearing are really struggling at the moment, but yet this webinar was all but sold out. So people are still excited about wanting to invest, wanting to get learn about this topic, and presumably have got the capacity and the ability to invest. So that's really exciting, isn't it, Patrick?
Yeah, definitely. And, it's been a great 12 months for investing. So maybe that's why there's such enthusiasm at the moment.
We're just getting 22-23 results coming out from super investing. And yes, it's generally an 8 to 11% returns for a lot of super funds in growth and high growth portfolios. We'll talk about that in a moment. But yeah, there's definitely still plenty of opportunities out there, which is exciting. So let's go through the plaque now. Legal thing, our disclaimer, this is what we call general advice, i.e. what you can do. Obviously, we don't know you yet. There'll be opportunities for us to have a chat, which we'll discuss later in the presentation. But if you want us to talk about what you should do, book in for a chat. That's what we call personal advice, and we can go from there. So for those who don't know me, my name's Chris Carlin. I've been in the industry now for 11 years. I was the founder and CEO of Master Your Money Now, but recently acquired by Vista Financial Group. I've got two little girls, Charlotte and Chelsea, and they take up a lot of my time. But it's great that I'm able to fulfill what I love doing, which is helping primarily millennials with their finances. And still doing that. Master Your Money Now, like I said, we've got about 140 ongoing members specialising in millennial nurses and teachers. We're based in Geelong, but we've got clients Australia-wide. And like I said, we've just been acquired by Vista Financial Group. Patrick, who are you?
Yeah, so I'm an advisor, as Chris said, and I've been with Vista now for nearly 12 months, which has gone pretty quickly actually. Yes. But I'm based in Bayside, so in the Beaumaris office. We're down in Geelong today.
Yep.
But yeah, deal with clients all over Australia. And I specialise in wealth accumulation, retirement advice and insurance as well. So a bit of everything really.
Yep.
But yeah, really enjoy that wealth accumulation space, which is sort of what we're talking about today. And yeah, personally, I love camping, footy,
Excellent.
Basketball,
Excellent.
anything active. So
yeah. I know you're very passionate about your Carlton Blues.
Yeah.
Got a good win on the weekend, so that is excellent. So, alrighty. So, and tell us a little bit more about Vista.
Yeah, so we just moved to Beaumaris at the start of the year. We were in Sandringham prior to that, but Vista's been around for about 30 years, I think. Originally based down in Gippsland, but now in Bayside, and we service all needs really across the financial space, whether it's younger clients, middle-aged clients, or your older clients looking at aged care as well.
Yeah, no, definitely can look after pretty much everyone really, with a very broad team of advisors, like with millennials, which is probably what we're primarily talking about today, all the way to Sonia, who looks after our aged care clients as well. So plenty that we can help with. So again, if you have any questions, put them in on the chat. But let's start off from saving to investing, a beginner's guide to starting an investment portfolio. And I guess the reason that we wanted to do this topic, because we come across it all the time. We've got clients who have got, particularly I find it with nurses as well, who are generally great savers, but taking that next step to investing is a challenge because generally they've got 20, 30, maybe 50 grand saved in a bank account. and they've got that buffer there. They've generally got good budgeting and all that kind of stuff, but it's just taking that next step, which can be a challenge, can't it, Patrick?
Yeah, definitely. And I guess, making sure you've got that good foundation before you even start investing is really critical. And that's sort of what we've outlined here, is those first steps before you even start looking at investing.
Yeah.
And cash flow is really that first step. So a few things we've listed down here is increasing your income. So there's many ways of doing that, whether it's increasing your current salary if you're a full-time employee, looking to get a pay rise, or is there other job opportunities out there in the market for you? Or is it a side hustle? Is it doing something on the weekend that you can make a bit of money off that is a hobby? So there's lots of different ways of doing that. But once we've maximised our income, I guess from there we want to start looking at expenses and see where we can cut back on expenses. And the best way, or the way I like to do it, is start from your biggest expense down to your smallest expense. And that way you can make some big savings to start off with, and then maybe work down to the finer detail on those expenses.
You've taken a budgeting course, which we could talk about for a whole hour and summarise it in about 30 seconds there, which is fantastic. And just going back to your income, I know I always get the question, what's the best investment that you can do? And I always say it's in yourself and your ability to earn an income. So, and I know it is challenging where things are at the moment, but if there is any ways that you can increase your income, certainly focus on that. And that would be that's a great starting point as well, especially if you, like I said, Patrick talked about foundations. If you are struggling to build a bit more of a buffer to invest, then look at ways to increase your income, decrease your expenses. They're definitely that starting point that you want to look at before you start investing. And then high interest debts, we'll come back to the money, investing all your money in a moment, but those high interest debts, why is it so important to get rid of those?
Yeah, so basically the interest you're paying on those debts is more than you could earn in investments a lot of the time, unless you were in a very high risk investment that did amazingly.
Yep.
Sometimes with credit cards, when they're 18-20%, it's very unlikely you're ever going to earn that level of interest or growth. So if you can pay those off first, you're going to be making more out of your money than investing it before you pay them off.
We always use the phrase a dollar saved is a dollar earned. So, and this is all about trade-offs. So we would say with for example, a share portfolio, very generally speaking, long-term, you would get 10% return per annum as an example. Well, if you had the option of investing at 10% per annum, or paying off a credit card that's 20% per annum, you get rid of the 20% per annum debt first every day of the week. So, there's definitely a few foundation points that we would look at to consider before we even have that discussion about investing. I know help's very topical at the moment with the recent interest rate of 7.1%. That one's probably a little bit more of a 50-50 one, whether to pay that off or to start investing. Pros and cons of that one, but definitely if you are carrying some high interest debts, we want to make sure that you clear those. And then from there, we want to make sure that you've got a cash buffer. So that question of, should I invest all of my money? I would say the answer to that question is definitely not. But why, Patrick?
Yeah, so it's primarily to make sure you don't have to draw down on your investments if there is a period of time where you've got more expenses coming in, but then the market might also be down. So you don't want to have to sell down investments if it's been a bad 12 months, or you're going to lose money on that investment. So making sure you have a cash buffer there, and that might change whether it's 5,000, 50,000. Each person has their what they're comfortable with having there as a savings, emergency savings, but have that there in place before you start investing to make sure that you don't need to draw upon those investments if anything happens.
Yep. No, I totally agree. Because Murphy's Law is if you did need to draw down on your investment portfolio, it's of course going to happen when the market's down and you're going to be locking in losses, all those kind of things. So making sure that you've got a cash buffer, making sure that cash buffer is not too high as well. Every individual's different, but if you're going to draw some numbers out of me, I'd say minimum 10, ideally 20 for a nurse or a teacher. If you do have, say, a property or properties, then that money could be a little bit higher. Generally because I've seen clients that have had over 100 grand just sitting in a bank account doing not much. That's probably too much of a buffer as well. So it's all about a bit of a balance in regards to making sure that you've got a buffer there, but not too much just sitting away doing nothing. Because ultimately, we want to get your money working just as hard as you do.
Yeah, definitely.
Yeah, excellent stuff. So if you do have any questions on that, make sure you put them in the chat below. But I guess the next question is, well, all right, we've got the foundations right. We've got some we've got some good income. We've got the capacity to save. I think a lot of people struggle with that next step, which is, all right, I know I should invest. I know I should be doing something, but I just don't know what. And crucially, I don't know why. So why is why so important?
I think why is so important because it gives you, direction. You know why you're doing this, and you're probably a bit more driven to do it because there's a reason, there's a goal in mind that you're building up this investment portfolio for.
Yep.
And then it also allows you to make better decisions in terms of structure, risk levels, and allows you to decide that time frame. That's got to be really important with a lot of the structured decisions you make down the line. So short term, it gives you that guidance and understanding of what you're doing and why you're doing it, but long term, it probably helps you save on tax and other maybe risks out there.
Yeah, definitely. And just the importance of having that why when things do get a bit tight or a bit tough, if you've got a clear goal to say that this is for, I don't know, a house deposit or your kids' education, whatever that might be, that's just going to help you push through, if things do get a bit tight and you get to that point, I don't know, 1, 2, 3, 5 years, whatever it might be, we're kind of like, why am I doing this? What's the point? I'm not getting the returns I thought. Maybe if the market's not doing, to be able to push through some of those tough times, that only occurs if you've got a strong enough why, doesn't it?
Definitely, yeah.
Yeah, so, and then what is success to you? Because, and this might sound a little bit weird to say, but most people that I certainly speak to, even millennials, aren't seeking the best return, are they?
Yeah. Yeah.
So what is success? What does that mean? And how does that align with my risk tolerance and time frame? Can you elaborate on that?
Yes, I guess it's really about, what are you going to be happy with for this investment portfolio to achieve? Is it the return as Chris has just mentioned, or is it a number that you want to build that to within a certain time frame? And with that time frame, I guess having the time frame in mind and the amount. So what is the figure you're building towards? Those are probably the two main things there when setting the goals that you want to link that to.
Yep.
Because if you have the time frame and the amount, you can sort of work out how much do I have to earn, how much risk do I have to take, how much risk am I willing to take from that to achieve that goal in that time frame.
Yeah, because even using an extreme example like super, for example, like, okay, a lot of us can't access that for, well, certainly in our demographic for a good 30 odd years. But if you know how much roughly you should have or how much you want to have in retirement, that just helps you to go, all right, I'm 10 years into a 40-year plan to accessing super. Am I on track? Because well, at least the numbers that I personally use, for like a millennial nurse or teacher, we would say as a couple, they would need, say, 3 million roughly to retire once we factor in inflation, all that kind of stuff, which sounds like a huge number, but when you break it down, it's 1.5 million each for a couple. Yeah. And we would say that superannuation, if you're working full time, will triple every 10 years if you're in a growth or high growth portfolio. So 1.5 million at age 60 equates to 500,000 at age 50, 150,000 at age 40, 50,000 at age 30. So if you're a 30-year-old looking at this senior super statement saying, well, I've only got 60 grand, Chris just said I need $1.5 million, it seems like ages away, but actually you're on track. In fact, you're ahead of the curve if you do have 60 grand at age 30. So just being able to have that end point and then to be then to track how you're going towards that end point just makes a huge difference. So, and then in terms of what is risk tolerance, what do you mean by that?
So I guess risk tolerance is the level of risk you're willing to take. Because each investment that you choose down the track will have a different level of risk. If you're putting money in the bank, it's pretty safe. Obviously, you haven't got a huge fluctuation like a stock market might have each day. So you've got to make a decision, and that's something that a financial advisor can help you through. Or there's a lot of surveys out there to help you figure out what level of risk you're willing to take. To sort of figure out then down the track what sort of investments do I want to choose.
Yeah, because at the end of the day, yes, we all love the 20% returns, but if that investment, good year 20%, bad year does 30%, if you can't handle that 30% loss, then you're going to do, sadly, what a lot of people did. For example, during COVID, where the market dropped 30%, their portfolios went from, certainly let's use a retiree example for this, went from 500,000 down to 350,000, a 30% loss. They panicked and put everything into cash. And so when the market did recover back to within the next 6 months, and if they stayed there, portfolio would have gone to 500,000. They've locked their losses in at staying at 350,000. So if that's a loss that you're not comfortable with, that's totally fine. We just got to make sure the investments that you've got are not going to have a 30% loss to begin with. So again, I'm using a retiree example where they're probably not seeking the most volatile investment. They want to seek something that's got some safe-ish returns slightly above cash and term deposits. Whereas for a millennial, if you are someone that's starting a investment journey, and I don't want to use the phrase have a punt, but someone who can take lose 20%. Well, I've started with a couple of grand, not the worst thing to happen. That's as long as you're aware of that and understanding those conversations, that's what we're getting at here. So anything to add to that?
And I guess we see with a lot of clients that these change over the years. You might start with a risk tolerance and a time frame, and then that will adjust along the way. So these things aren't set in stone, and you probably want to be looking at them, that we'll mention later on, constantly reviewing those and seeing if they've changed in the last 12 months.
Yep, absolutely. It's we say we write our plans in on paper, not in stone, because your situation may change, the market may change, the legislation can change, new opportunities can come up. It's just finding out what works best for you, and that is constantly changing. So, so hopefully that makes sense. Again, if you're liking this, give us a like, leave a comment, and let us know what your thoughts are there. But I guess the next step, selecting a platform and investments. You've got the funds. We know that we're going to put in something on an upfront and an ongoing basis. We've got that worked out. We know what this money's for, what the purpose of this is. How do we then select a platform and investments? What's the process that you go through in order to do that?
Yeah, it's such a tricky decision nowadays because there's so many options, whether you look at micro investing apps, share trading accounts like a Self Wealth, or you look at just investment accounts and investment platforms out there as well. So you've got so many options in terms of the structure that the investment's in, and then also underlying in that what you're investing in, whether it's direct shares or ETFs that you've probably heard about. But then there's also managed funds. So do you want someone managing that money for you and investing it for you? There's lots of different options, and I guess what we'll have to weigh up here is how much each of those cost you. In terms of each of them have different fee structures, each of them have different costs. Each of them have different risks as well. Whether you're going directly to a cash product, there's probably a lot less risk there as opposed to going to an ETF that's all in equities. So different levels of risk in the individual investment options, but then also individual structures of investing as well. And I guess one way of looking at this is how much control do you want to have over the investments? Do you want to be looking at them every day and making changes and selling stocks, or is it more of a set and forget investment option where you can put money into it and it's invested in a way that you're comfortable with, but you don't actually need a lot of work to maintain that over time?
Yeah, a lot to unpack there. Let's start off with there is a difference between the platform, or what we call the administrator, and then the underlying investments. And it's amazing how many people come to us and say, I was with XYZ platform, they performed terribly, I don't want to go with them again. And you look at it, it's kind of like, well, actually, you're in a cash-only portfolio, a very conservative portfolio. We see this with super, or I see it with super still. People are like, I'm with, a top-rated industry super fund, but it hasn't performed. You look at their statement where you're invested in cash earning 1 to 2%. That's why it's not performing. So it's really important to note the difference between the administrator and the investments within that portfolio, because generally speaking, not always, but generally speaking, the investments are going to perform similar across platforms. If you're in an Australian share portfolio with one platform, it's going to perform very similarly to another platform. So picking the platform or the administration service first is ensuring that's separated from the actual investments that you select. They're two different decisions, and really important that you separate those. So what should people look for when it comes to selecting a platform or administrator for their investments?
Yeah, with the platforms, I think cost is really important. So some will cost you a lot more than others for doing pretty much a very similar job. So making sure that the platform's not going to cost too much for what they're providing you. And then the underlying options. We'll talk about the options that you have a bit later on.
Yep.
But making sure that it's one that fits within those risk profile and investment horizon that we spoke about before. So yeah, you're not all in an equity option if you've only got a short time frame of investing for.
Yep. No, absolutely agree. I think also ease of use as well, because we're definitely not saying go with the cheapest, because there's definitely cheap and nasty out there, and I don't care how cheap it is. If it's impossible to use, don't use them. Pay a little bit extra for a platform that is easier to use. Does make a world of difference. But definitely in terms of investment options, that is really important as well. Because, for example, if you want to invest in direct equities or shares, for example, you're going to pick a different platform if you wanted in comparison to going with, say, managed funds or something like that, won't you?
Yeah, definitely. And I guess different approaches as well. Is there one going to be one that you want to log into all the time and check the app on your phone, or is one just you want to transfer money into and forget about it? Yeah, and
that's really important as well. So, and then the tax consideration, and again, this is one where we could spend a whole nother hour on this, and I talked about it briefly on another webinar about investing for your kids, but summarize for me, what when you say don't get caught out on tax, what do you mean by that?
Yeah, so there's more than one way of holding an investment account. You can hold it in your name, you can hold it in your partner's name, or you could hold it in joint names in a trust. There's so many different ways of holding investment options. So making sure that the structure and the way that you're holding that investment option is in line with your goals. So whether it's a long-term investment or a short-term investment, I think understanding how that structure and the ownership of the investments affects you long-term, short-term, because things like interest and dividends within investment options might come onto your personal tax if you hold it in your own name, and as well as capital gains down the line. Something to think about at the end of the investment. When do you want to sell out, and how are those capital gains at the end of that investment portfolio are going to affect how you sell out, because if there's a massive tax bill at the end, it might erode a lot of that earnings and income that you've had along the way.
So how does interest or earnings or capital gains tax gets calculated when it comes tax time?
So your income and dividends just gets added on to your personal tax rate. So if you're a high income earner, it might go all the way up to 47% of the income is then taxed. And the capital gains is a bit more of a complicated process, but essentially they work out how much capital gains you've had on the investment, so how much has it grown in value when you sell it. And then there is sometimes a discount on that of 50%, which then once they work all that out, it gets added on to your personal income tax as well.
And what you say is just so important, because to use a practical example, like if you've got 100 grand, maybe not from day one, but you've built it up, you get a 10% return, make $10,000. If you're paying 47%, let's call it 50% in tax, well, there's $5,000 lost straight away to tax. So if there is another structure and there's a few options out there that have the same investments but enable you to pay less tax in a legal, ethical manner. We're not sending anything overseas, but if there's a legal, ethical way that we can do to reduce your tax and ultimately keep more for yourself and less for the tax person, that's really important. That's the importance of getting these structures, these foundations right. Yeah, it might not sound as appealing or as or exciting at the start, but it does make a huge difference over the long term. So, for example, we could, in that example, reduce the tax bill from 50% down to 25%. That's just going to add significantly more to your long-term wealth if you make that change and get that structure right from the start.
Yeah, definitely.
Yeah, excellent. So hopefully, and again, if that's something that you do want to chat about, yeah, like I said, because there is a myriad of options, make sure you speak to an advisor on that topic. So understanding investment basics. So because we've talked about the platforms, we've talked about, I guess, the administrator and what you want to do. You've kind of figured out a plan in regards to what you can invest in. What's the next step in terms of understanding investment basics?
Yes, I think, and as we've written here, is investing the same as a savings account? And that's a lot around. You don't want to treat it like a savings account.
Yep.
You don't want to be pulling money out of that all the time. You don't want to be putting it into that. And that's because of something called timing risk. So you don't want to be losing money, selling down investments while they're down in a down week and buying back in the next week when they might be at a higher valuation. So making sure that the money we're putting into this investment account is a long-term investment or just for our goals that might be 3 years long and not drawing upon that every week or every month. It will really allow it to sit there and grow and probably perform the best it can.
Yeah, because as you rightly said, you don't want to treat this like a transaction account where you're pulling in money in and out. Not only is it going to impact your long-term returns, you're going to get hit with by probably a tax bill, but also high fees as well. So making sure that it is separate. And then that risk and reward, like we've touched on that, but I think it's a very valid point. Like if there's no point investing in the share market if you need this money in 6 months. Okay. Generally, if you're looking at a share portfolio, you want to hang on for the long term, which is 7 to 10 years. So if you've only got a short time frame, this goes back to the why conversation. If you've only got a short 6 month time frame, then a conservative option like a cash term deposits is probably going to be the best option for you with that short term time frame. But if you are willing to accept longer term a time frame, you've got the ability to hold your investments for the long term. That's where a risky investment can be more important, and that risk and return is really kicks in as well, doesn't it?
Yeah, definitely. And as most people know, there's a inverse relationship between risk and reward. The more risk you take, the more reward there is possible. But obviously not going all the way to the end of the spectrum with some investments out there that you can hear about on Instagram, I'm sure. But as long as it's in a structured investment that you're confident in, there is the ability there for that reward over the long term. But it is really over that short term that we'll see volatility in those risky assets.
Yep. What do you mean by volatility?
So short-term fluctuations in share prices. So the last 6 months we've seen the market jump up, 30% overseas, 10%, probably not 10% in Australia, but a lot in Australia as well. But you can also see the inverse of that. So over the short term, you can see big crashes like in 2020, in the GFC crash as well. You can see drops of 30 to 40% in a few months, in a year. So that short-term volatility is the risk there with the high-risk assets. Over the long term, though, we know if you hold those growth assets, you'll be rewarded.
Yep, absolutely. So, there's plenty of things to cover off there. Now, let's go into a bit more specifics. Should I dollar cost average and regular investment plans? What is dollar cost averaging?
So dollar cost averaging, some people love it, some people hate it. There's mixed opinions. But it is one way that you can reduce your risk when you're investing a large amount of money. So it's putting money in over a time frame of let's say 6 months. If you've got $100,000 in, and staggering that in over the 6 months. And the benefit of doing this is if the stock market drops in value or the investment you're investing in drops in value over those 6 months, you're then buying in at a lower price. But you can also have the inverse happen where the stock market goes up and then you're suddenly buying in at a higher price for the next 6 months as well. So, it's not guaranteed that it's going to reduce the risk. There could be, you could be buying in at a higher price, but it does, it is one way of reducing that by putting all your money in at one time. And I think the next one there, regular investment plans, is, I stress this every time that it's probably the most important part when you're starting these investing strategies is that what you're putting in on a regular basis, whether that's, $200 a week or $100 a month, the bigger that you can make that regular investment plan is the faster the investment's going to grow. Because at the start, you find that what's really growing the portfolio is those regular investments and the money you're putting in. And it's just the way that it works with the size of the portfolio, that the growth on that, even if you have a great growth rate of 10%, the money that you're putting in is going to be greater than 10% of the value of the portfolio. So the more you can put in at the start, the better you're going to be off in the long run.
Again, if we use super as an example, if you think of a 20-year-old or a 30-year-old, 9 times out of 10, I was assuming they start with a small balance, they're going to get their best growth not from their returns. It's going to be based on their contributions. Yep. So we've got a graduate nurse, 25, earning 60 grand, roughly 6 grand into super. If they've only got a 10 grand balance, well, then they've got to get a 60% return on their super in order to get more than 6 grand there, which I can't recall happening. A 60% 1 year return on super. I don't recall that happening any time in recent history, that's for sure. So once you're getting started, the returns, the best returns, they're important, but they're not the primary factor. It's what's going to be driving it is your contributions that you're going to be putting into this. But then again, using the super example, we wait till you're 50. Let's say I've got a $500,000 balance, 10% return on that is 50 grand. Well, even if that nurse is working full time, I'd say even gone up to management on say 150, 15 grand a year is well short of the $50,000 that they've got from investment return. So that's where it's really important that if you can make those regular contributions, dollar cost averaging, the more you can do that, the better. Yeah,
and that's why we started with the cash flow, because the better your cash flow is, the more you can put in at the start, and not, cut back on expenses too much, so you don't have to enjoy life anymore. But just making the buffer there and the cash flow surplus as big as possible is going to allow you to grow this as quick as possible.
Yep, absolutely right. So now, different investment styles. You listed value, growth, index. We probably should talk about ESG as well in that conversation as well. But what do you mean by these investment styles, and can you break down all those options as to and why some people choose to pick those options?
Yeah, definitely. Some people look to go with one of these investment styles. Some people go for a blend of the investment styles. And what you'll find is these different styles of investing perform well in different sort of markets. So lately we've seen, it was a growth market, shifted to a value market, and now it's probably back to a bit of a growth market again. So one investment style will perform better over certain periods of time than others. And what these generally mean is a value investment style is investing in those companies that provide really good profit to their investors and dividends as well. So they're really solid companies, like your Woolworths or your utility companies as well that don't fluctuate in value a whole heap, but provide really good yield and growth as well. And that growth investment option or investment style is probably your more technology sectors, your ones that go up in value by 30% and also drop by 30% too. So they're your more the companies that you're looking for growth in the value of the share price, as opposed to maybe that yield you might earn through dividends. And your index is a little bit different in that what an index option is investing passively across a whole share market. So there's a lot of companies, dealing in this space that are very popular in Australia. And what they do is they invest along a broad share market. So they might invest in line with the Australian market. So like the S&P ASX 200, which is buying in all 200 of the top Australian companies.
Yep.
And what this allows you to do is basically have an investment option that tracks the market. So if the whole Australian stock market goes up in value, your investments will also follow that as well.
Yeah, so another way to say that is if you see on the telly or the newspaper that the share market has gone up 1%, then an index fund, if it's tracking the Australian share market, would also go up 1%. Whereas a growth or a technology portfolio, like you mentioned, if the share market's gone up 1%, then that portfolio's gone up probably 2%. But on the flip side, if an index fund goes down if the market goes down 1%, if you're an index fund, you've probably lost 1%. But if you're in a growth technology portfolio, you've probably fallen about 2%. So all things to keep in mind. And now talk to us about ESG, because obviously indexes just replicating the market. So you're not really concerned about what investments that you're in. But a lot of people, especially millennials, are becoming more educated and I guess more in tune with their options. And we're not here to say one's better than the other and, ESG, ethical investing. My ethics are different to your ethics, Patrick, and it's different to yours watching this. So what is ethical ESG investing? And when you're having that discussion with the clients, how do you determine what's best for them?
Yeah, so ESG is exactly that, investing ethically.
Mm-hmm.
And there's different levels to it, I guess, different investment options within ESG look at different things. So there's lots of different ways. There's, the climate, of course, and investing positively in line with climate change is a big one that people often say, but there's also other things, such as slavery in third world countries, and a lot of other factors that come into ESG too. So it's not just the climate, which I think a lot of people think it is tobacco, guns, lots of different options in that. So what you find with ESG options is they can be quite complicated because sometimes they'll scope out, say, climate change, but then they'll include everything else. So you've got to really make sure, what are you, what ethically do you align with, and what do you ethically want to invest in, to make sure that option actually scopes out the things that you don't want to be investing in and you don't believe in.
And it does have a lot of detail. For example, I know one of the biggest super funds that markets heavily in ethical ESG stands for environmental and social governance. One of their biggest funds in that space have a larger exposure to technology, especially things like Facebook and Twitter and all that kind of stuff. And I know when I show people that, they're kind of like, that Facebook and Twitter are ethical companies? Really? Not sure how it ticks that box. So this is where it can be a bit of a rabbit hole in terms of the detail that you can go down. But that's where, this is your money. You get to decide what is important to you in terms of how you invest it. So, yes, there could be some trade-offs, especially like we were talking about fees before, like an ESG portfolio or an ethical portfolio is considerably likely to have much higher fees than an index fund, simply because there's more work involved. But if that's a trade-off that you're happy to make for to be invested in an ethical portfolio, then go ahead and do it. And I don't think we would stand here and say over the long term you're better off in an index fund or an ESG portfolio. Historically, they've done the same. Ethical funds have underperformed in the last 12 months because generally they have got an overexposure to technology stocks. But the previous 5 years, 3 to 5 years, ethical funds have done pretty well. So, I mean, it's not about who's going to give you the... It's amazing how many people come to me, and I know you're the same too, Patrick, that, I want to invest in ESG because I hear they've got better returns. Even if that was the case, that doesn't mean it's going to be the case going forward. So, what's important to you? What sort of style do you want to be invested in? Make those decisions first before you consider investment returns. Yeah,
definitely.
Should I stick to one investment? Or maybe I'll rephrase this. Should I stay in the same investments for the entire period of my when I'm investing?
So I think it's a really tough question to answer without knowing what the investment is. But I think what is important is sticking to that style as well. So maybe if it's not that one investment option, say one ETF or one index option, I think sticking to the style is probably very important, because if you're jumping around, as we were talking about before, different styles perform better in different markets. So making sure you're sticking to that one style, and then if you still have conviction in that one investment, stick with it even if it's underperforming, because it's likely just the market cycle that you're going through at the time, and you might be buying into that investment at a discounted price as you were 6 or 12 months ago. So sticking with that one investment can be a really strong way of bouncing back in the portfolio, because you can catch up basically to the growth that you lost in the previous.
It really is a balancing act, because you look at, say, the worst performing investment options, and then you review it 12 months later. Half of that list 12 months ago, they were underperforming, will be the top performers next financial year. And then the other half are still in the bottom. So it is a trade-off, and as you rightfully said, it really depends what you're invested in. But it's certainly way too simplistic. In fact, probably bad, I'll go as far as say bad advice, to just go for the ones that have performed the best in the past, because as the fine print on all those industry super funds say, past performance is not an indicator of future returns. And then asset classes influence risk return. Can you elaborate on that point?
So you've got your shares, whether they're international or Australian. You've got property, infrastructure. These are generally what we call your growth assets. So a growth asset's going to have a much higher relationship with risk in particular, and maybe that return over the long term. So understanding which asset classes you want to invest in and are going to influence that risk and return, because you might want to balance that on the other side of the coin with defensive assets like bonds and fixed interest and term deposits, to maybe get a level of risk and return that you're comfortable with. So you don't want to be all in one basket and uncomfortable with the level of risk. So how do those asset classes that there's lots of different options out there, how do we balance those out and diversify across those to reduce the risk and also put you in a level of risk that you're comfortable with?
Yep, absolutely. That all makes sense. So if you do have any more questions, again, if you're enjoying this, hit us the like button. And if you do have any questions, leave them in the comments. So we kind of touched on a couple of these, but monitoring and reviewing your portfolio, can you elaborate on the points there? Because realistically, investing is an ongoing process. It's not a once-off set and forget. Can you elaborate on that, please?
So going back to those goals, looking at those, I think, as well, in context of the investment portfolio, I always say don't log into your portfolio or your super every day, because it drives people crazy looking at it going up and down, because it will go up a lot up and down, especially once your balance gets into the higher ranges. Losing 1% at $1 million is a lot more than losing it at 10,000. So looking at those numbers going up every day can drive you crazy, but definitely log into it, once a week, once a month, whatever suits you, to check on those investments, see how they're tracking, and can allow you to, if they are down, can I buy a bit more this month to buy at a lower price, or do I need to maybe cut back this month and wait for the future to put a bit extra in? So making sure you're looking at it to keep track of how they're going, and in a year's time maybe set a date that you can review those investments, see if you're still happy with those investments, if you want to change it up a bit, if your risk tolerance, as I mentioned before, has changed at all, if it's not performing as you thought, do you want to take a bit more risk? Or if it's performing really well and you've had a great 12 months and you want to peg back the risk a little bit, do we reduce that as well? So there's lots of different options there depending on how it's gone, whether you're happy, whether you're unhappy, but just making sure that you're looking at it and you don't forget about it. So we don't want to be checking it every week, but we also don't want to ignore the 6 monthly or annual statements and have those build up, and then 5-6 years down the track go, oh, hang on a sec, this hasn't been doing what I wanted it to do. What do I do here? So just getting that balance right is very important. And of course, we talk about those goals. Goals change. So if your priorities change and things like that, how does the plan change in order to meet those? Does your investments continue to meet your goals and requirements? So excellent stuff. So
I think we've covered anything. If you have any questions, whether you're watching this live or on the replay, let us know in the comments. More than happy to assist. But I guess one of the things a good thing about financial advice and investing is you don't have to do it alone. It's not like the gym where I need to get fit, I've got to do it myself. I've got no other options there. But when it comes to investing, you can outsource this to someone else, such as Patrick, myself, and go through some options there. So if you did want to have a chat about your options, go to the link masteryourmoneynow.com.au/get started, and myself or Patrick, we can have a chat, see if we're a good fit, and go from there. So you've definitely got a few options there. Our next webinar, this one's going to be a little bit more advanced, but it is with the Managing Director of Vista Financial Group, Tyson Roberts, who looks after, I guess, the more complicated clients, which generally are done through a self-managed super fund or an SMSF. I know it's a very popular topic, but it's one that a lot of people have a little bit of knowledge about, but not all the knowledge. And that a little bit of knowledge can be quite dangerous, because an SMSF can really be beneficial, but if it's done wrong, then it can really blow up. So the link to that, to Eventbrite for that one will be there as well. But any final words before we wrap this one up?
No, I don't think so. I think just it's such a complicated area of investing, but it just gets started with it and work through it one step at a time.
Yep.
Because getting started is really going to make all the difference. The earlier you get started, the better it's going to be in the long term for yourself.
Absolutely right. The hardest step is to get started. So if you need help getting started, reach out. Let's have a chat, and we can go from there. But thank you again, Patrick, for your time. It's certainly been great fun, and thanks to those who are watching. We'll catch up with you very, very soon. But in the meantime, have a great day, and again, let's help you to achieve your tomorrow. Have a good one.
See you later.